You just got off a 10-hour shift, sitting in your car, and you pull up a listing for a 3-bedroom house at 300 grand. You stare at it. You make decent money. You show up every day. You do everything right. And yet, something in your chest already knows the answer before your calculator does. So, here is the reality of the housing market right now. The median home price in America sits around $410,800 as of early 2026. Projections for the rest of the year say prices will only grow about 1 to 2%, bringing the median closer to $415,000 by December. That slow growth sounds like good news on paper until you realize prices have nearly doubled in the past decade across most of the country. A $300,000 home is technically below the national median, which means it should be achievable, right? Sit with that. Mortgage rates are a massive piece of this puzzle. In 2026, the average 30-year fixed rate is projected between 5.9 and 6.3%. Compare that to the sub 3% rates people locked in back in 2021. And you start to see the problem. Every single percentage point change in your rate translates to hundreds of dollars a month. Meanwhile, the median household income in America is around $84,000, projected to reach roughly $87,000 by the end of 2026. Wages are growing 1 to 2% a year, while the cost of everything around you keeps climbing. Sound familiar? Here is where it gets interesting. Let me walk you through the actual math on a $300,000 home. And I want you to pay close attention because this is the part where most people stop wanting to know the answer. Start with a 10% down payment. That is $30,000 out of your pocket before you even get the keys. And you still owe closing costs on top of that. For context, the median savings for Americans under 35 is about $8,000. So most young buyers are already short by 22 grand before they even see a lender. Your loan amount after that down payment is $270,000. At a 6% interest rate on a 30-year fixed mortgage, your monthly principal and interest payment comes out to roughly $1,618. Now, stack on property taxes. The national average is about 1% of your home value, so that is $250 a month. In a state like New Jersey, where the rate is 2.23%, you are looking at over $500 a month just in taxes. Then add homeowners insurance at around $156 a month nationally. And because you put down less than 20%, you get hit with private mortgage insurance, or PMI, adding another $123 a month. Add it all up, your total monthly housing payment lands at roughly $2,147. Think about that for a second. That is $25,764 a year just in housing. Using the 28% rule, which says your housing costs should stay under 28% of your gross income, you need to earn at least $92,057 a year to afford this home. Run that number again. $92,000. The median household income is $84,000. Most American households are already priced out of a home that sits below the national average. Read that again. And we have not even touched closing costs yet. Those run 3 to 5% of the purchase price. So tack on another $9,000 to $15,000. Maintenance runs 1 to 2% of your home value annually, meaning $3,000 to $6,000 more every year. If you have kids, the average childcare cost in this country is about $1,200 a month. Suddenly, that paycheck is doing the work of 3 budgets at once. Now, let me break this down by who can and who cannot make this work. If your household pulls in under $50,000 a year, A $300,000 home is off the table entirely. Even with the smallest possible down payment, your monthly costs would eat over half your income. You would be spending more on a house than on food, transportation, and everything else combined. At 50 to 80,000, you are in the danger zone. You might squeeze in with minimal debt and a low-cost area, but one surprise car repair or medical bill could wreck everything. You are one bad month away from falling behind on payments. Between 80 and 120,000, things become doable with careful planning. Dual income couples, maybe a teacher and a nurse, can manage this in the Midwest or the South. The catch is that average student loan debt sits around $37,000, which adds roughly $300 a month to your obligations and pushes your total debt ratio right up against that 36% ceiling. Above 120,000, and you are in comfortable territory, especially if you've built equity from a previous home. Here is the thing that makes this even more frustrating. Location changes everything. In Toledo, Ohio, the median home price is about $200,000. In Dayton, it is $239,000. In Birmingham, Alabama, $181,000. A $300,000 home in these places gets you a solid house with room to spare, and you might only need $70,000 to $85,000 in income. Meanwhile, in California, the median home price is projected at $905,000. In the Bay Area, over $1 million. A $300,000 home there basically does not exist unless you count a studio next to a freeway on-ramp. And here is something wild. In 55 metro areas across the country, homes listed under $300,000 make up less than 1% of total inventory. That means in over 50 cities, the home we are talking about today is practically extinct. So why is all of this so brutal in 2026? 5 reasons that are quietly stacking up against you. First, wages have grown 4 to 5% recently, but home prices have jumped over 50% since 2019. Those two numbers are heading in opposite directions. Second, about 70% of current homeowners locked in rates below 4%, and they are not selling, which is strangling the supply of available homes. If you already have a low rate, why would you give it up to buy something more expensive at 6%? You wouldn't, and most people aren't. Third, the country needs about 1.5 million new housing units every year, and builders are only putting up less than 1 million. Zoning laws, land costs, and weather events keep slowing everything down. Fourth, Americans are carrying $1.7 trillion in student loan debt, and childcare costs $15,000 a year on average, eating 20 to 30% of household budgets before housing is even considered. Fifth, insurance premiums are up 11% nationally, and in states like Florida, annual premiums can top $5,000 due to storm damage risk. Here is what you can actually do about it. There are over 2,000 down payment assistance programs across the country. FHA loans let you get in with 3.5% down. VA loans offer 0 down if you qualify. Co-buying with a family member or trusted friend is becoming more common, with platforms built specifically for that. If remote work is an option for you, look at relocating to markets where your money goes 2 or 3 times further. Modular and prefab homes are coming in cheaper per square foot than traditional builds in many areas. And if your timeline is flexible, rates are projected to come down further as the Fed adjusts, which could save you 5 to 10% on your monthly payment. The good news buried in all of this is that wages are finally projected to outpace home prices in 2026, for the first time since the financial crisis. It is a slow shift, but it is real. And when wages grow at 3%, while prices only climb 1%, the gap starts to close month after month. That is momentum working in your favor for once. Remember that listing you pulled up in your car after work? Now you have the actual numbers. The math is brutal, but it is not a mystery anymore. If this video changed how you think about buying a home, hit subscribe and share it with someone who needs to see these numbers. I'll see you in the next one.